So here are my 5 financial moves that every woman should be making before 2026. It is crazy to me that we are approaching the second half of 2025. If you don't know me, my name is Renee Cohen, and I'm a certified financial planner for high achieving women, and I help you make good life and financial decisions. So this training is meant to be quick. It's not meant to be labor intensive. It's not meant so you're sitting down and you're like, "Oh my God, I have to carve out another hour of my life." Because I know for myself, I'm busy and I just like these quick little trainings so I can at least take in 1 or 2 nuggets. So, here, number one is you start to think about wealth as a permission, not as a safety net. Most of us have been taught that money is some sort of safety net and that it's a cushion for when things go wrong. But when we're building wealth, it's more about just feeling safe and secure and living a comfortable life in our future. It's also about giving yourself permission to live the life that you want to be living. So, there's always going to be that balance between living now and then also in our future. I'm always a big proponent of enjoying your life today without sacrificing for your future. So that balance is going to look different for every single one of us. And when I'm working with clients, I'm understanding as to what's most important to them so I can help them find that balance. So for you, write down 3 things that you would do if money wasn't a limitation. And so often we think only in the constructs of, well, I don't have enough money, or if I had money, I would do this. So again, if money wasn't an object, if there was no limitation, what are the 3 things that you would do? And calculate those choices. And I know that this may not be the easiest thing to do, but as best as you possibly can is calculate what those choices would cost you. And that's where we want to now create a permission fund, name it something exciting, whatever is meaningful for you, and then start setting up automatic transfers to that fund. This is going to be different than your emergency fund. I call it a permission fund or a flexibility fund. This is going to give you permission to either spend or to save towards something that's in the future. I absolutely hate the word budgeting. I just hate the concept of budgeting. I hate the word budgeting. It comes from such a scarcity mindset. So, once or two, stop treating cash flow like a budget. We want to get out of that mindset of like, this is a budget. It's looking at what your monthly income is and what your spending is. So whether you're a business owner and you have variable income, or you're a W-2 employee and you know what your paychecks look like every single month, we still all have income that's coming in and we have spending. And highlight where you're spending your money, what those expenditures are that is helping you build your future, and what is draining you. So the things that are going to build your future are investments. It's either paying down debt, and that's okay if you're in the phase of paying down debt versus putting money into investments, or maybe doing a combination of both. It's also self care, right? We cannot be depleted in this world and also worry about our future. We have to take care of ourselves. Health is wealth as well. So we want to think about our health or any sort of health care that is meaningful for you. So that is an investment into yourself, which is just as important as putting money into other types of investments. So when you're looking at each of these areas of, again, what are you investing in for the future or for yourself, or what's draining you? If something is draining you, then that is either where we can cut it out or decrease it. Um, Sometimes there are things that we're spending money on is that we can't just completely eliminate. And that's why I hate traditional financial advisors just saying cut it out, because sometimes that's just not possible. And so it's about reducing it versus just completely cutting it out. And it's also about shifting the mindset around where can I cut? And instead of saying that, it's around what can I fund that's going to help me get closer to my dream. And I know that may sound lofty, but when we are really clear on what we want to achieve or what we're aiming for, then that is the intrinsic value and motivation that we have to put money aside for that future goal. And again, our future could be 6 months from now, a year from now, 3 years from now. It doesn't always have to be 30 years from now. And then organize your goals into four buckets. Short term, now in the next 3 years, I consider that short term. Midterm, 3 to 7 years. Long term, 7 years plus. And then retirement is age 59 and a half plus. So retirement and long term may blend into each other, but we have certain accounts like 401ks, IRAs that are specifically for retirement, 59 and a half, age 59 and a half plus. So I consider retirement as its own separate bucket because long term dollars may you may have goals that are pre-retirement, so you're going to need money for pre-retirement, so that's also considered long term. The third thing is tax planning is not optional. A lot of times people will think that, okay, taxes is a once a year thing. I file my taxes, I don't have to deal with it until next April. But especially as you're making more money, tax planning becomes more and more important. These are the small moves that you can make throughout the year to make sure that one, you don't have any surprises come next April when you are filing taxes. One, two, that you can be proactive in making some of these moves and that you're not just surprised or you're just relenting to what your tax bill is going to look like. So what this means over the next 6 months until we end, for the next 6 months over until till the end of 2025, some of the small things that you can do if you're self-employed, make sure that you're tracking and deducting every eligible expense or forecasting what those expenses could be for the next 6 months. If you're in the corporate setting, are you taking advantage of all of your dollars that you can put into the 401k? If that is 23,500, if you're under age 50, if you're over age 50, that is 30,000 up to $30,000. In an IRA, traditional or Roth, it is 7,000. Or an HSA where you can, depending on you're single or married, you can put up to almost $8,000 into the health savings account. So these are ways, small little things that we can do to deduct more money. I often see people will say, well, yeah, I'm maxing out my 401k, or I'm putting money into the 401k, putting a little bit into their HSA if they have that as part of their plan, but they're not maxing it out, but yet they have a tax bill. So why not take advantage of these vehicles that allow us to lower our taxable income today? And give us that tax break. Now, we also want to have a combination of vehicles that are going to uh, not only lower our taxable income today, but also lower our taxable income later on in our future. And also this, I see a lot of people get tripped up, especially when they have RSUs or different type of stock options like non-qualified stock options, which are called NSOs or ISOs, incentive stock options, employee purchase plan. So all of these types of options can really trip you up, but you always want to be keeping your eye on, like, am I at a certain income threshold when it comes to tax brackets? We're in a marginal tax society, so the more money that we make, that threshold above a certain number is going to be taxed at a higher rate. So it's why it's even more important to make sure that we're thinking through our deductions. And then using our tax buckets strategically. And what I mean by that is use the different types of accounts that we have to your advantage. Maximize the growth and in your peace of mind. I see a lot of times that we're overly concentrated in one bucket versus another bucket. And it's not to say that you have to have balance across all three of these buckets. It's really about, again, your goals and what your timeline is relative to either financial independence, what you're looking to achieve in the future. But we still want to have a mix of all three of these buckets, which is taxable, which you know as a brokerage account. And what I mean by that is that you're putting money into an investment account, you're choosing those investments, and you're really getting no tax breaks other than holding that investment for at least a year, and you're paying taxes on the gains on a year-to-year basis. So the trade-off with the IRS is that you can put as much money as you want into this vehicle, and on a year-to-year basis, you're not limited. You're not limited on how much you can put in or when you can take those dollars out. So the trade-off is that you're being taxed along the way. Whereas tax deductible is what you know best as a 401k, a traditional IRA, where we're not paying taxes today. But because we're not paying taxes today on the dollars that are going in or any of the growth, Uncle Sam's coming for us later. And Uncle Sam does not get any cuter. He's not cute today, and he's certainly not getting any cuter later on. So we do not want him snuggled up into our bed completely. So although those accounts are great for us now to lower our taxable income, again, we want to make sure that we're pairing this with other types of accounts to lower our taxes later on, which is also a tax-free account, which you know best as a Roth IRA. And if you make too much money to put money into a Roth IRA, then you could be doing what's called a backdoor Roth, or you should look at your 401k plan if you work in corporate to see if you have an after-tax component within your 401k plan, which allows you to get even more amount of tax-free dollars. So take a look at your current accounts, and what kind of mix do you have? Are you all in tax deductible? Do you have just a little bit in taxable? Do you have none in tax-free? Do you have a little in tax-free? So really take a look at that mix that you currently have, and then decide based on your goals how to kind of trigger that or recalibrate that percentage so you're having more of a balanced mix. And then the fifth one is invest for your goals, right? This isn't about anyone else but yourself. And as you're looking at your investments, whether that is in across all of your accounts, brokerage account, 401ks, IRAs, anything else that you may have, is rebalance your accounts. If you haven't done so in a year, you should be rebalancing your accounts on at least once a year, maybe twice a year basis, because as your life changes, so do your investments. So a lot of times in our 401ks or in our retirement accounts, especially if it's done through a company, you may pick the default, which is a target fund date, and that target fund date does rebalance for you. But a lot of times, if we're picking our own investments, it's not being rebalanced. So I can't tell you countless times I see clients coming to me and their investments are just not aligned with where they are today. So it is really important to rebalance these accounts. And if you're not getting the professional help to do that, then at least be able to know how to just build just a basic portfolio or put it in a default fund that's going to help you with that rebalancing. And making sure that you're doing these money check-ins at least twice a year. A lot of times we're thinking about just our accountant because we're filing our taxes. But as you make more money, you should really have a financial team around you. You should have an accountant or CPA. You should have a financial planner. You should have an estate planner. You should have all of these people on your financial team, even if they're not, you're not needing to talk to them on an everyday or every month basis. These are people that should be your go-to. So we're not only building our wealth, but we're also protecting our wealth. And if this feels so overwhelming because we have multiple accounts, just pick one account this month to look on and see if hey, are my investments aligned with where I am today? Did I pick these investments as a default and haven't even looked, or have I just picked this when I was in my 20s and haven't and just let it ride? Just pick one account. So there you have it, the 5 moves to make before 2026. And if this is something that you're like, I need help putting all of this together, or I just need help with making one move, then I am offering a personalized money audit. This is obviously I'm going to need some additional information. I need to know where you currently stand financially. How much do you have in the accounts? So this, if you click on this QR code, this will take you to a link that will allow you to give me that information, right? Obviously in a very secure way. Or you can DM me at my Instagram, which is It's Money with Renee, money audit, and I will provide you this link. And what we'll do is, once you upload that information and I have a good understanding of bigger picture, then I'll schedule some time with you and do this personalized audit. It will be an hour worth of our time where you can ask any questions, and I can identify the areas that you're doing really well and also identify areas of opportunities, so you can walk away with just some tangible action items that is personalized to you. So there you have it, and continue to follow me on Instagram, because as much as I'm a behind the scenes type of person, I am creating more content so you can make smarter money moves.